I'm Rob Collins. Welcome to the Specialist Finance Show. Today we're going to swap things around a little bit. I'm going to be asking the questions because today we're looking at business finance and Andrew is the expert on that. So we'll run through and ask him some questions.
Sounds good.
Okay, so the first question I have here is, will I need to give security over a property to obtain a business loan?
Rob, not necessarily over a property, but you will have to give security of some sort. And with business lending, there's generally kind of four categories of security that I can think of. You've got General Security Agreement, or GSA, and your GSA is like a blanket security that the bank takes over the business. And it's its way of gripping your receivables, your inventory, your plant and equipment, all those bits and pieces of value that sit inside your business. So General Security Agreement, it's often termed GSA, so you'll hear GSA more than anything. The next thing you'll come across, particularly with asset finance, is something called an SSA. And an SSA is a specific security agreement. With your specific security agreement, it's where a lender is taking a specific charge over something within that business that they have lent on. So typically, it could be a truck, could be a piece of plant and equipment, something like that. The next one come across is guarantees, and guarantees come in a whole bunch of forms, but the one that you'll come across most in terms of privately owned businesses is the personal guarantee, and that's a guarantee where the lender can kind of look beyond the business to the shareholders as guarantors. So if I own a business and I'm the shareholder on the guarantee with the bank or the lender, then I'm liable to have to cough up in a worst case scenario. So they can kind of look through me into my other assets and bits and pieces for recovery.
Okay.
So that's what a personal guarantee is. Very common these days. Very hard to not have one of those in place with a lender. And then lastly, we talked about the question being without property finance, but yeah, property finance does still play a part in business finance, particularly commercial property, where often the business is owner occupied in terms of it owns its own premises and it works out of those. That often will come into that group of security that's provided for the lender. Yeah.
Okay, that all makes sense. Okay, so you touched on asset finance there. So run through some of the differences between cash flow and asset lending.
Yeah, okay. The two different approaches. One very much focused on the value of the asset and the other the value of the cash flow in the business. Let's just start with a bit of an example, if you like. Lender is providing funding for a truck for a business, $50,000 of value, say, and they're lending $20,000 on that. The simple asset finance or asset lending type approach to that is that there's plenty of headroom between that value of the asset and the remaining debt that they'll be owed. So worst case scenario, they sell the truck and repay the loan. So that's simple asset lending, if you like. Now, if I was a cash flow lender, I'd approach that more from the level of the business and its ability to repay me, so the financial capacity of the business to repay me. So I'd be looking at the business is making on a monthly basis in terms of cash flow and or an annual basis, whatever measure they're looking at in terms of the term. And then I'd be going and seeing if there's enough headroom in that cash flow to actually cover the repayments that they have to make on the truck.
Right, okay.
Now, with cash flow lenders, they'll still take security in terms of the truck itself, but that's more of a second way out, so that's if things got into trouble.
That's their safety net.
That's their safety net, yeah. So yeah, that's the two, in a very simple form, that's the two different models, yeah.
All right, the next question, Andrew, is funding for a startup. Can you get business funding for a startup?
It's not impossible, but on this occasion I'm going to say no. Generally, startups are funded through shareholder capital or equity until they reach a level of stability in terms of profitability. So you'll hear people say that the riskiest time in a business lifespan is the first 3 years, and that's typically how lenders look at it. They want to see you sort of get through those early stages, and they want to see that there's underpinning profit there that would be able to support the lending.
Right.
Now, there are exceptions to all these things, and doing a startup but have an existing business or have a relationship that goes back a long way where they know and can see a greater group, or the ability to back that new lend. But typically on a standalone basis, banks would expect to see 3 years worth of profitable trading in
Right.
terms of financials before they provide a debt. Yeah.
Okay. So startups are tough, but what about somebody who wants to buy an existing business?
Yeah. So that's kind of standard stuff in banking. Usually an existing business has got a track record, and you're buying it because it's got value in it. So that's bread and butter for most banks to be doing that sort of lending. The key things that they look at in terms of the business being bought is what are you buying? With smaller businesses, you tend to be buying not the limited liability, but the stock and debtors essentially. And so they want to know that those are all in good shape and that you're not overpaying for them. With larger acquisitions where you're buying the actual company itself, they'll be looking to make sure that, yes, you're buying at the right price in terms of what you're buying in terms of stock and debtors and bits and pieces. But they'll also be looking beyond that to make sure that you've got no other liabilities that you're picking up with that business. And overall, with all business acquisition, one of the key things that lenders will look at, banks or other, is that you're actually capable of running that business, that you're the right guy to buy it, and that you've got the skill sets needed to actually be successful for it. And if you're light on those, you've got a management team that you're buying as well that isn't going to walk away, but is going to stay with the business, and you've got that continuity of making a good go of actually transitioning across.
Okay, so you've got the objective review of the numbers and the kind of subjective view of the management team.
Yeah, that's right.
Right.
Yeah.
Okay.
Yeah.
So I guess that if funding for an acquisition is possible, then businesses that are looking to expand, it'll be a similar scenario?
Yeah, similar sort of stuff. With growth finance, if you want to call it that, there's the same sort of approach to things. Has the business got the financial capacity to take on further debt? Is that growth sustainable? It's backed by good numbers in terms of historic trends. It's got a forecasted picture that's clear and easy to understand that makes sense. Lenders are conservative, so they never like to see big hockey stick forecasts. They'd much rather see sort of consistency of performance. And that's hard for business owners because business owners often can really believe in their story and where things are heading. It's that sort of gap between giving the lender comfort and scaring them that you've got to kind of bridge. And often with a good, strong growth business, that's a pretty scary sort of business to bank for a lot of lenders. So yeah, you've sort of got to moderate those things and be a bit conservative around them for lenders.
Okay.
Yeah.
So when buying a business, what are we looking at in terms of gearing and affordability assessments?
So a little different to what we've talked about in other episodes with property, where it's sort of all around LVR and those sorts of measures. With businesses, you typically, when you're buying a business, you're buying perceived value, and you're buying at a multiple. So you're basically saying that I'm buying the next 3, 4, 5 years worth of value that business can bring me. So the typical model for a business is that we talked about it earlier, you're either buying the stock and debtors or you're buying the limited liability. With stock and debtors, it's often that you'll pay value or maybe a discount for the stock and the debtors, depending on the quality of them. And there's a goodwill piece over the top of that you're going to buy. That adds up to your kind of enterprise value. With a more sophisticated business where you're buying the actual limited liability, it tends to come back to the enterprise value being a multiple of EBITDA. with all these things, let's just take a basic example. If we think that the EBITDA of the business is $1 million and we're prepared to pay a multiple of 4 for that, then the enterprise value is $4 million. Now, just using that example, if we went to a bank to look for finance, the bank would be potentially comfortable ending up to, say, 2.5 times that multiple. So 2.5 million on the scenario of $1 million EBITDA. What you've got to be conscious of when you're funding an acquisition is that the more you pay for that business, the bigger that equity hole is. So in this example, if I decided to pay 7 times multiple for that $1 million EBITDA business, that's a 7 million acquisition. The bank's not going to give me more because I've paid more. They're still going to look at it and say, well, we're good for 2.5 times that.
Yeah.
So you've still got the same debt, 2.5 million, but you created a large equity hole. So that's the bit that you've got to look at. And it's the same to some degree with the stock and debtors thing. You'll go and pay stock and debtor value plus some goodwill. Always tie it back to what's that underlying historic EBITDA value been in that business, because it's the same sort of multiple that we'll get back to talking to banks about or lenders about. So you've got to be comfortable that enterprise value is going to be earned out over a sensible sort of period, and debt will get repaid.
Yeah.
Now, it makes great sense to have debt. The more leverage you've got in a business, the better your return, obviously. So you'll always be pushing to try and get as much in as you can to get that return up. And, like we've talked about on other things, is a bunch of scenarios that play out, and I've seen banks that have gone a lot higher than 2.5, but that's kind of just what we're generally talking at the moment in terms of a debt multiple.
Right, okay.
So 2.5 times EBITDA. Yeah.
Okay, and just a little bit of jargon busting for anyone that doesn't know what EBITDA means.
Yeah, so it's essentially taking your net profit in your business before tax and adding back the big 2 items are interest and depreciation.
Okay, and if someone is buying a business, they add back, and obviously any funds the previous owner has taken out, they can be added back to that net profit as well.
In terms of that sort of scenario, the big one is obviously adding back the salaries of the former owner. But you've still got to pay yourself, so consider those things as well.
Okay, excellent. Thank you, Andrew.
No problem.
And we'll see you for the next episode.
Sounds good.
Bye-bye.
See you next week.